Thank you for joining us today. And we are going to start with our very first session for the month of September, which is Mastering the 1040 Conversation. Now, this is what I wanted to bring to you for this session, because as I see when I explain a tax return to a client, it just opens up their eyes and they just feel so much better for understanding how their financial situation is. And what that brings is referrals for us. But before we dive into our session, I'm excited to introduce to you, if we haven't met before, the Nadia CPA Inner Circle. If we personally have not met, great to meet you. I'm glad you joined us today and look forward to continuous education through the Inner Circle. My name is Nadia Rodriguez. I am a CPA that's based out of Dallas, Texas. Been in business for over 15 years. I did used to work for the corporate world and also manage my tax advisory, tax compliance, CPA firm on the side, but now I do it full time. I left the corporate world after 18 years, and now I run my practice, but also do education. That is where my passion lies, is education and bringing in that knowledge for everyone. Now, maybe if George can help us mute those participants that are in, just so that we don't hear the background noise. If we can, everybody just mute yourself. Okay, here we go. Then we also have George Rodriguez. He's my husband, my COO, the one that is behind the operations to make sure everything is running as smooth as possible. He is a photographer during the day, and in the evenings, has been amazingly contributing to my dream and my passion for education, making all these intricacies in the background run together smoothly. And then welcome everybody to the team, Jesh. Jesh has been onboarded with us this week. She has been an amazing contributor already. She is in charge of marketing operations. So you might see her more active in the inner circle, and she's helping us out, has been amazing. With that, we will go on to what we are planning to learn today. Of course, we're going to go into the 1040. We're going to walk you through what a 1040 looks like. We're going to first build the foundation, because all of us in this room are familiar with 1040s, but let's make sure that we all start with the same foundation. Once we go through that, we're going to walk you through a real life example, which I've changed the identifying information for all of that, through a 1040 and how I explain this to my clients. Now, I do run my tax practice is 100% virtual. So I record a video for them, walking them through what I will walk you through today. And they get to keep the video and refer to it later. And then what kind of questions you want to ask your clients to make sure that that conversation runs smoothly, so that they become also familiar with what happened during the year. And we're going to talk about Schedule C, right? Because Schedule C and self-employment tax, I think that's one of the biggest surprises to our clients, especially if they're transitioning from a W-2 into just being full-time or even part-time. That self-employment tax is the biggest surprise for them. So how do we build that client trust? Is by explaining to them what happened to them, right, during the year financially, and how we got to where we are today. Just starting off with a personal story. Back when I was 18, I don't know if anybody here in the room has heard this story, but I've shared it a couple of times. When I was 18, before 18, I was at W-2 working in retail, a part-time job right after high school. And then at 18, I got this amazing job as an administrative assistant to a realtor. I was so excited because I no longer had to do no longer had to do retail. Instead, I had to work behind the desk and do marketing, publishing, PowerPoints for this realtor and open house flyers. But she paid me a 1099. I had no idea what the difference was between 1099 and a W-2. So what do I do? What I've done it every year since I was in the workforce was walk into an H&R Block with my 1099 and was expecting a refund. Instead, I had a huge amount due. I didn't understand the preparer. I did not explain to me. I didn't ask questions. I didn't know what questions to ask. So what did I do instead? I talked to friends, and they referred me to a friend that knew how to do tax returns and how the tax system really worked with loopholes. And so that's exactly what I did. I took my 1099 to this one person and walked out with a huge refund. Back then, to me, it was huge. Instead of me paying about $2,000, I was getting a refund of $1,500. And I said, this sounds more right to what I've been used to, because as a W-2, I was always receiving a refund. Then what happens? I get audited by the IRS. It was shortly, maybe about 2 years after I received that refund, I get audited asking for receipts for my backup on my Schedule C. I had no idea what this meant. I tried contacting the friend of a friend. They were no longer in business, could never be found. So what did I do? I went into the IRS by myself to try to figure out what this was, because surely they were mistaken. I sat down at the IRS office with the auditor, a very sweet man, and understood the horrible mistake I have made and walked me through of what self-employment tax is versus having a W-2. After the beautiful explanation he gave me is when I got the bill. Not only did I have to pay the $2,000 back, but I had about $5,000 of fines and penalties and interest that I had to pay back. So that was a very costly lesson for me at the age of 18. But what it did inspire me to try to figure out what is going on with the tax system, to understand it, so that not only can I explain it to those friends that referred me to that friend, but also my family and those around me. Because the tax system is intimidating to many. And if you're not in the business of tax, it can feel very overwhelming. And that's what inspired me to go into school and get my master's in tax and get my CPA license. And so that is my mission now, is to spread awareness, spread the knowledge, and bring these taxes to be less intimidating for our clients. Now, 64%. A study was done by CPA Practice Advisory, and they determined that 64% of Americans are confused with the tax system. And so this is a great opportunity for us in the business, to be able to explain to our clients how the tax system works, bring them the clarity, which then results in referrals to us. So we're going to start off at the very top, because the tax forms, the tax system, it all starts with income. And we know that golden rule that all income is taxable. That is the general rule, unless there is a code section that says that income is not taxable or is exempt from tax. So we're going to talk about earned income, because we have earned income and unearned income, and these are taxed differently in the US. Earned income, we know that. It's what you and I do every day, right? We work for our money. We earn this money by doing something. And so the most common earned income types that we have: W-2 wages, tips, self-employment, the contractor, anything that you receive with the 1099 NEC, not miscellaneous. Miscellaneous is usually not subject to self-employment tax. Commissions, bonuses, anything that you're doing in action to receive that income. All earned income is how I explain it to my clients. It's subject to 4 taxes. Now, the 4th tax, it depends on what state you live in. So I say we all have to pay 4 taxes to the government. One of them is the federal income tax, and that gets paid to the IRS. The IRS then provides it to the government, and they fund programs for us, the roads and any kind of special funding that the government needs this for. That is our contribution to the US tax system. And then we have Social Security and Medicare tax. Social Security and Medicare tax is a tax that we have to pay on our earned income, which is used to fund that Social Security and also Medicare fund. Now, I do tell our clients this is funding that fund right now for those that are benefiting from it, but they are keeping tabs of how much we are contributing to it. Every year, the Social Security and Medicare tax that we are contributing, we do receive a statement. So at the end, when we are at that age of being able to collect from it, we have proof of how much has been paid into the system on our behalf. And then the 4th tax, state income tax. I am the state of Texas. Texas does not have a state income tax, but that is a tax that is collected by state agencies, and it's used for state funding for programs that the state does provide. So yes, if you have a client that is in a state that has state income tax, they are subject to 4 taxes. What about the unearned income? That's the income that you earn without having to move a finger. It's really your money earning some income for you. And so what do we have? We have interest income, dividend income, capital gains income. Rental income, right? Rentals are usually passive, even if you have a rental that maybe you manage on your own. It all depends on the law, how many hours you're putting in there to be able to deduct the losses or to consider it a short term rental. But in general, rental income is passive, unearned income. Social Security benefits, unemployment compensation, alimony. Alimony received only if the divorce was finalized prior to 2019 and you are receiving alimony. Inherited income, gambling winnings, these are considered unearned income. Now, why does it matter for us to differentiate between earned income and unearned income? Because come credits, there's credits throughout the tax system that depend on how much money you have made as earned income. One of the most popular ones, earned income tax credit. If you make nothing but just unearned income, you will not be able to claim an earned income tax credit. Now, our unearned income, there's 3 types of taxes that you can pay for unearned income, which is our ordinary tax rates. And think about interest income. You have a savings account, it starts to gain some interest income. That's subject to your ordinary tax rates. But if you have a stock that you held on to it, maybe some Tesla stock, a company stock, that you had held on to it and you held it for more than a year, as long as you hold it for at least 12 months and then you sell it, the gain is subject to capital gains tax rates. And as you can see, capital gains tax rate can be taxed as low as 0%, and the highest would be 20%. But if you notice ordinary income tax rates, the lowest you can be taxed on ordinary tax is 10%. There's no such thing as 0% ordinary income tax rates. And then we also have that net investment income tax. Now, what that is on unearned income, the interest income, capital gains. Not only are you having to pay capital gains tax, but you could also be paying additional net investment income tax. Now that kicks in for those taxpayers that are making more than $250,000 of income. That is what they have to pay, a 3.8% additional to the capital gains tax rate or the ordinary income tax rate that they paid on interest income. It's a 3.8%. So once you have all of your income, you've gathered all that income together, let's start reducing that income, because remember, the more we reduce that income, the less we have to pay in tax. So we come across first adjustments to income. Now, most of these adjustments, they're able to reduce that income before we even arrive to adjusted gross income, AGI. And so first we start with just income, make these adjustments, and arrive to AGI. The most common, health savings account contributions, IRA retirement account contributions, student loan interest, tuition and fees, self-employment health insurance, and the alimony that you do pay out. All of that are allowed adjustments to income according to the U.S. federal tax law. We get to reduce it, and now we arrive to AGI. But wait, further, we can even deduct AGI even more by deductions from AGI. We have our standard versus our itemized deduction, right? We can't have both. It's either or. It's the one that's the greater is the one that wins. Qualified business income deduction. If we have qualified business income, now rentals are not qualified business income, especially if you're passive. General law is that rentals are passive. So you do get a 20% of a deduction from AGI of the profit of your qualified business income. And then now starting this year, 2025, we start to get 4 additional deductions from AGI. And that's the tip income deduction up to $25,000, the overtime deduction, $12,500, car loan interest, $10,000, and senior deduction, $6,000. Now, if you're not too familiar with this or want a refresher on these new deductions that came with the One Big Beautiful Bill, which do start in 2025 and are only temporary, the last year that we can benefit from these additional new deductions is the year 2028. You can always access the recap that we do have in the inner circle to just bring you up to speed on the rules that have to be met in order for you to receive this type of deduction. So now that we were able to begin at income, we took a deduction. We were able to adjust that income down by those adjustments like the health HSA contributions, the student loan interest. And then we arrive to AGI, adjusted gross income. From there, we're able to do some more deductions, reduce that AGI by those adjustments that I just talked about. Now we arrive to what we call taxable income. And so this is key for us to become familiar with the official name that we see on the tax return, so that when we're reading tax law or we read articles related to tax law, we are familiar with, well, are they talking about AGI? Are they talking about below the line or above the line? Taxable income is what we have arrived to after making all of our adjustments to income and to adjusted gross income. So taxable income, now this is the amount that we use to calculate our federal tax. This is what gets run through the federal tax brackets to see what our tax liability is. Now this is a graphic, and this is what I like to show my clients. And you do notice we do have resources for you, which this is one of the handouts that we will allow you to download. We have removed the watermark that says Nadia CPA Inner Circle. Feel free to put your own logo on it. But this is something that I like to visually show my clients, because sometimes when they think about tax brackets and somebody says, well, what tax bracket are you in? And they're familiar, they probably think maybe in the 20%. We need to make sure that they are aware that not all of their income is taxed at that specific tax bracket. Instead, our US tax system works almost like a step system. The very first level begins from any income. This is an example of those joint returns. If you're a joint, married filing joint couple, all of your income from $1 all the way up to $23,850 for the year 2025 is subject to a 10% tax rate. Now, this is for the year 2025, and we know that every year these brackets get adjusted. And what I mean by brackets, it's those amounts at the very beginning and the end. So $23,850, up to that amount, 10%. But did you make more than that? Is your taxable income more than that? Then we step up to the next level. Anything above the $23,850 all the way up to $96,000, that range is taxed at 12%. And then we go forward with every level. Once we get the calculated amount at every step that we're going up, we add it all up, and that is our tax liability. So yes, your highest tax bracket could have been at maybe 22%. It doesn't mean that every single dollar of your taxable income is subject to 22%. So that's something that I like to explain to the clients, that I don't want them to think I'm in such a high tax bracket. It just means that that's the last bracket that you were liable for. So that's how we arrive to tax liability. That's the total amount that you legally owe the government for the money that you made. I do tell my clients the tax liability. This is the amount that you owe the government. That is your responsibility. However, how can we pay for that tax? Well, we'll walk you through that. But before we get excited of, okay, this is what we owe the government, are there any other taxes that we're liable for? We are. There are situations where you could pay above your tax liability to the government. And so what are those other taxes that are in the tax system? Self-employment tax, right? That's the most surprised tax, and probably the highest, the 15.3% of self-employment tax. Then, of course, we have the other one that really surprises people is when they cash out their 401k. They take money out of the 401k and they're not at the age of 59 and a half. They get taxed a 10% penalty, really is what it is. 10% of what they took out. That is just a tax, just a penalty. And then we have household employment taxes. That's if you have an employee at really what's considered an employee, a nanny is what they call this nanny tax. There's a tax that you have to pay for that. Also, the repayment of the premium tax credit. How many of you have had to deliver these news, not good news at all, to your clients because when they were getting their insurance on the marketplace, they gave an amount of taxable income that was under what they really earned for the year. And when it comes to tax time, that is when you do the reconciliation of how much income did you really earn in order for you to either pay back that tax credit. So this is another one that is a big surprise for my clients. But I do work with them and I say, let's do a check-in. half year to see how your income is and what is the amount that you provided to the marketplace in order for them to determine your tax credit, your premium tax credit. And if their income is higher, then we need to adjust that, because that's when they start reducing that tax credit and their insurance premiums are going to be higher. But again, it avoids that surprise at the end of the year when it comes to tax time. Self-employment tax. Now we know self-employment tax is a 15.3%, but when it comes to self-employment tax, this is what I explain to my clients, because all they see is the amount. And it's not a very, they're not very happy about how much of self-employment tax they have to pay. But I do tell them this is based on the profit of your business. You did not have an employer to help you pick up the bill for half of this. That 15.3% does seem like a huge amount, but remember, this is funding. This is going into your Social Security and your Medicare fund. And this is the way you calculate it. Social Security tax, 6.2% per side, because you don't have an employer helping you out. Medicare tax is 1.45%, in total 15.3%. So I do see some kind of, relief when I do say this is to fund your Social Security or Medicare tax. It hurts to pay it, but at least it's not like you're paying the federal income tax alone on that 15.3%. But there are ways to reduce our self-employment tax, and that's when we step into tax advisory. So then how can you pay the tax liability, right? We've calculated what our taxable income is, ran it through the tax brackets. We have our tax liability. How do we pay for that amount? There's different ways. Do we have tax credits that are available to us? Do we have federal withholdings that were taken out of our paychecks? Do we have estimated taxes, maybe some quarterly payments that we did send in? This is the time we reconcile with the government. The non-refundable credits. We know that those credits are able to reduce that tax liability, but not below zero. They're limited to tax liability. Yes, they can bring your tax liability to zero. That's great, but nothing past that. The most common ones, the child tax credit, which we know for the year 2025 is $2,200. But of course, the new law says that those parents claiming the child tax credit must have a Social Security number. Not both parents, but at least one of them. Then we have child independent care credit. Those expenses that we pay for daycare, you get to deduct a 20% of those expenses and then calculate the credit based on that. Education's credit, savers credit, that's if you're contributing to your employer's 401k, to a retirement account, and your income threshold is underneath that threshold, then you do qualify for a savers credit. And of course, we have foreign tax credit. If you paid a credit outside of the US, you do get to receive a credit to reduce your tax liability, but not below zero. We do have refundable credits. Those actually allow you to reduce it below zero, and which results in a refund, money back to you. Earned income tax credit, the additional child tax credit, and the American Opportunity Tax Credit is what is refundable to you. Okay, so we're going to go through a 1040 explanation. We're going to pretend that we have a client. So good to meet your client right here. You have a family that walks in. It's Jose and Marta Reyes. They are married, filing joint. Marta, she's a stay-at-home mom. Jose, he has had a job with a W-2 for 6 months, and then he started his own business. He is now a Schedule C self-employed entrepreneur. They have 2 dependents. They have high medical expenses, and they're talking about to you that this year it's going to be even higher because if both kids, need braces. They just have higher medical expenses. And they have self-employed health insurance, right? They left the W-2 job, but they did go out to the marketplace and get some insurance because now that Jose has his own business, they do want insurance for the family. This is what I do first. After I prepare the return, I've asked the questions to the client. At this point, if I'm preparing their return for a prior year, there's not much we can do when it comes to advisory because the year has closed. Instead, my priority is to bring them compliant with the filing of their tax return before the deadline. And now I know when they walked in that they were Schedule C, I know that amount that they're going to owe, or I don't know the exact amount, but I know there's an amount that's going to be owed. So time is of the essence. Let's try to get this liability paid as soon as possible before more interest starts to accumulate. So we're going to start off with the client. I have prepared their return, and here I walk in and I show them their W-2, because before I even tell them how much they owe, how much of a refund they get, I want them to understand how we get to the amount at the end. And how do we get there? Is, hey, by the amount of income that you earned or didn't earn, maybe unearned income, what is all of your income for the year? Let's take a look back at how 2024 looked like. Let's assume this is a 2024 W-2. So we start off, and this is what I talk to my clients about. I said, let's look at your W-2, box 1. That's the amount that we will see on your tax return. That is what the income that you get taxed on. Now, it's not the amount that you probably saw deposited into your bank accounts, because there's reductions to the amount of salary, or the amount of wages that you did earn. But box 1, that is what we are bringing into your tax return. Now, sorry, there's some noise in the background. Okay. There is, if you can just mute yourself. Then we talk about, okay, why didn't I see $63,000 in my bank account? Well, there's reductions because there was withholding from that money. And what happened is your employer has to, by law, withhold your Social Security tax, your Medicare tax, and then your federal income tax. Now, the federal income tax, it's when you filed and you filled out your W-4 to let your employer know if you have dependents, what your filing status is. And they did their best estimate to reduce your paycheck by those taxes that are in a savings account, basically, with the IRS getting withheld. And the IRS is holding on to that money in the meantime while you reconcile and prepare and file your tax return with the IRS. At that moment, box 2, that is the amount that they're holding for you. We need to know, are we going to get any of that money back? Or do we have to pay more because our liability is more than what we had to pay in? I do notate this to them, especially if they have a difference between box 1, 3, and 5. Box 1 is what makes it to their federal tax return. Box 3 and 5, those are the total wages that are subject to taxes. Remember, we talked about the 4 taxes. Well, box 3 and 5 is subject to 2 of those taxes, which is your Social Security and your Medicare tax, box 3 and 5. And I remind them what it is. It's 6.2% Social Security, 1.45% of Medicare tax. And so I do notice also, I call it out. See, do you notice that there's a difference between box 1 and 3? There's a $2,000 difference. On your tax return, you will only pay income tax on box 1. Now, where's the $2,000 of a difference? Let's look at box 12. It looks like you contributed to a 401k with your employer. You contributed $2,000, which is great. And I do encourage them. I say, this is great because maybe even your employer is matching some of that amount. That's free money for you. But also $2,000, you don't have to pay income tax today. But do know this is a deferred tax. You pay income tax the day that you withdraw this money. Now you want to keep it in there until you're 59 and a half. If not, it's subject to a penalty, a 10% tax of that. But yes, it does reduce your income the day to day. And again, before I go even into the amount that they owe, I'm telling them all about income. We looked at their W-2. Now I take them to their Schedule C. I just flip through it and I show them Schedule C. And I remind them, this is how much you made with your business, $180,000 of gross receipts for the whole year or for 6 months. In this example, this client started their business in the middle of the year and did amazing, $180,000. When they came to me, they brought me these expenses. Now, I will tell you, this is just for educational purposes. I did change the amounts, but if you're seeing zeros at the end, maybe it's a coincidence. Try not to. I mean, this is where we don't want to be giving round numbers to the IRS for expenses because that will raise a red flag. But we're assuming that these are legitimate expenses. $800 of advertising, some miles that they drove. only $34,000 of expenses. And I do tell them $34,000, these are the allowed expenses that we can use to deduct the income on your business. But at the end, after reducing all those allowed business expenses, your business generated a profit of $145,813. And this is subject to self-employment tax, which is 15.3%. Remember, we had looked at your W-2 where you paid 6.2% and 1.45%, but your employer helped match those amounts. Well, now you are self-employed. You do not have an employer helping you out, so you have to pay the 15.3% of Social Security tax. And how much is that? That's $16,751. Again, this is used to fund your Social Security and Medicare funds to be able to be withdrawn at the age when you're allowed to withdraw from these funds. But that alone of self-employment tax is $16,000. Then we go into page 1. At that point, they're familiar. They're reacquainted themselves with what has happened during the year for their business and for their W-2, all of that income. And then we go through page 1. I said, hey, just verify for me that everything on here is correct. I always do that because we're human, we make errors, or maybe they forgot to tell me that they updated their address. Maybe just last week they moved to a different place. So I do have them, take a quick glance. Does everything on here look good? Your Social Security numbers, your address. And then we go into the income. I just kind of refamiliarize them with the income that we just walked through. And I said, remember 63,000 of our W-2. I do have in this example 5,000, which was dependent care credit. I didn't go into those dependent care benefits, but I reacquaint them with 68,000 of total W-2 income when you worked for your employer. And then you have net profit of your business, which we saw 145,000. So in total, your total income is 213,813 is what I walked them through. At that point, how can we reduce this income? Well, we can make adjustments. Remember how we talked about self-employment tax? It's 15.3% because you do not have an employer that helps you cover half of that. Well, the federal government allows you to reduce half of what you have to pay of the 16,000. They allow you to reduce that income on the tax return. And then you also pay self-employed health insurance. So yes, in total 20,000, we're able to reduce your total income. Even though you earned 213,000 on line 9, we're able to reduce it by 20,000, which brings us to line 11, 193,000 of income that we have. But wait, we're able to reduce it even further. And that's where I go into the deductions. The way I explain the standard versus itemized deductions, because what happens, the client gives you all receipts. They give you all their medical receipts. They give you maybe the 1098 that has the property taxes, or you're familiar with the state income taxes that they paid last year. They give you everything. So I want to make sure that they know that I didn't ignore those. Instead, what I tell them here on line 12, the way this works is we take either the standard deduction amount, and I do highlight and I show them over here to the left. Every year, the government allows us a standard deduction amount, which is really a deduction that the government has come up with. They're estimating our living expenses based on our filing statuses. You are a married filing joint couple, and you are allowed a $29,200 of a deduction for your standard deduction. But I did get to compare that to itemized. Itemized is your total medical expenses, your charitable contributions, those property taxes, the state income taxes. I get to add all of that up, and the amount that wins in your case was the standard deduction of $29,200. And then your other deduction, because you do have a business. Remember, you had $145,000 of a gross profit. We take 20% of that because there is a law that allows you a deduction for having your own qualified business income. So that's a reduction of $25,000. In total, we started off, your total income was $213,000 for the year. After the adjustments and after the deductions, we arrived to $139,000. That is your taxable income. And that is the amount that has to get run through the tax brackets to see how much of your tax liability it is. And when we do that, we are calculating a total tax liability to the government. Your contribution to the federal government is $20,719. But from there, how can we pay that liability? You do have a credit. You have two credits to children that are under the age of 17. You get $2,000 per child, and this is for the year 2024. That's a $4,000 credit to pay off that liability of $20,000. That brings it down to $16,000. But then remember, we have self-employment tax that we need to send in with your 1040, and that's an additional the $16,000 on top of what we just calculated for your federal income tax. You do have some money saved up with the IRS that your employer was able to take out of your paycheck. That total was $6,300, which at the end for the year 2024, you do have a balance due with the IRS because there is not enough paid in to cover your self-employment tax and to cover your federal income tax. That total is $28,369. But I do want to call your attention to line 38. There's an underpayment penalty because you did not pay your liability equally throughout the year, especially for that self-employed business. So if you underpay your tax during the year, the government does charge a liability for not paying enough during the year. At this point, I do not tell them about any tax strategies that I identified. Instead, because it's a lot of information, a lot of numbers that I just threw out at them. And so I say, listen, the amount of liability, the $28,000 that you're paying, there are tax savings opportunities that we can implement. However, we have to meet during the year before the year ends so that we can help you out with what you have so far of income, and we can plan better to reduce that liability. Instead of you paying the $23,000 to the government, there's ways that you can spend that money either within your business to reduce that taxable income, but we will need to meet for that. And I strongly advise you that this would be an amazing opportunity for you because you do have your own business. There's more tax strategies available to those that are business owners. But no, at this point, I do not reveal any kind of tax strategies because I still need to see their current year situation. And so this is where I say, book an appointment, let's meet, and let's really talk about the opportunities that I can help you with and how we can meet during the year instead of waiting until tax time when there's not anything we can do to lower that tax liability. But I am interested in hearing everybody's or seeing everybody on the chat, their opinion on, are there any strategies that you can think of? I'm going to take you up really quick up to where we were with the facts. Remember, they are a married filing joint couple. They have a self-employed business. Martha is a stay-at-home mom, and they do have two kids. We're assuming these kids are at the age where maybe they can work, right? Is that a strategy? I would advise once, of course, they contract me for advisory services, let's hire the kids. Let's hire the wife. There is a plan for hiring a spouse in your business, and you can have a medical reimbursement plan. So all of those high medical expenses that they have talked to me about, let's make them deductible instead of putting them on Schedule A, subject to itemized deductions. Is there anything else? I'm going to look at our chat and see if there's anything that anybody can. Oh, yes, Abraham, paying those kids. Yes, completely paying the kids is definitely a strategy. When you're a business owner, there's a lot more things that we can do. This is the point that we talked about. You just started your business as an electrician. Are there any assets? I didn't see a home office because when they came to me, they didn't have any kind of organized exclusive room for a home office. But you know what? Let's find a space. Let's find a corner somewhere in your house that we are going to section off with one of those dividers, those foldable dividers. Let's make it a home office, because surely you have to sit down somewhere to start doing your bookkeeping or start gathering your receipts or making your appointments with your clients. So yes, home office would be another tax. Yes, Joanne, invest in assets. They're 100% bonus depreciation starting January 20th of 2025. So let's talk about what other assets you have for the business. You need a work truck that you're probably looking into. Or maybe at this point, have they already bought the truck? Okay, let me run numbers for you. Let's see how much taxable income you are at as of today and how much more we can reduce it. We're going to estimate how much income you have left for the year. This is the time to act, and this is the time to offer advisory services, because surely when you show them the value of 23,000 that was paid to the federal government versus way less of a tax bill, and instead investing in their money in their business or in their kids, have their kids start earning the money, and now the kids can pay for their own personal expenses. There's lots of advisory strategies that we can suggest, but only if we are contracted to do advisory services. And that's something that I plan to roll out later too, on more really thinking about tax advisory. Because yes, we've done the tax return, we've helped our clients with tax compliance. Now let's really level up and do advisory services, where really the tax return, it's not going to be a surprise to anyone. We've been estimated what the tax liability is going to be anyway.